Hello and welcome to the 5 Minute Spare podcast. My name is Lewis. I'm joined with Craig, who also works at 5 Minute Spare, and Ian Waters, financial advisor. And today I'm just going to have a good chat about general financial matters, where the market is at the moment, and also equity release, which is a very new, upcoming, popular financial product that's coming onto the market. So what we'll do is we'll just go through a quick introduction with Craig, because we've not heard from Craig before. So Craig, can I get an introduction from yourself?
Hello, I'm Craig. I worked as a financial advisor in the past, and now I work at 5 Minute Spare in various capacities.
And Ian, can I get an introduction?
My name's Ian Waters. I'm a mortgage and equity advisor. I've been in the industry since 1985, so a total of 37 years. Predominantly dealing with private client work and locally within the Cumbria area. Fantastic.
When you say private client work, what does that entail?
Individuals, basically any individual. We're all different. They have various needs, whether it's to do with banking, borrowing needs, whether it's personal, like car finance, mortgages, mentioned equity lease and so on. So anything that deals with people and what they do in their life, if they need some sort of banking facility in support of that, I would deal with it. And certainly some of the roles I've had have been holistic, where whatever they needed I dealt with. It wasn't a case of just being a mortgage advisor or just a banker.
Fantastic. I've seen that you offer protection as well. What does protection actually entail?
Protection entails looking at each individual person, talking to them and identifying risk. Those factors that could adversely affect their lifestyle, their family, financially, if something goes wrong. And again, similar to areas of lending, it's individual. Some people have the ability to cope with a loss of income, perhaps through savings or equivalent. So again, what we tend to do is discuss the risks and then identify a most suitable product to mitigate that risk. An easy example would be with a mortgage. The largest risk statistically is not so much life cover, because thankfully very few of my clients have died of me. It's actually more to do with an area called critical illness, where a lot of us will incur what could be a life-threatening illness in our age range from 20 to 60, i.e. heart attack, stroke, and there is protection out there that would in effect pay off the mortgage should one of those events happen.
Especially if one gets, say, incapacitated in a certain way, can't carry on as normal.
Because work is often quite good at paying you short term, but if you're off work for longer term, benefit system is quite weak now, and yet you still got your full commitments. And certainly with critical illness, what it would do is repay the mortgage, and in effect what it would do is take away that pressure point. So if you are receiving treatment, for instance, for cancer, at least you haven't got that stress, and your family hasn't got the stress, and then there's a big mortgage to pay for.
Fantastic. So, I mean, in regards to a vital product that you can offer, I'm guessing that's right up there.
Yeah, and again, it's vastly underinsured in the UK. As a country, we're a strange entity. We invented protection, insurance and financial services, and it was one of the worst in the world to actually arrange the thing, which is a touch of irony in that, but it's perhaps our culture, our nature, and it's important that when we talk about protection, that the client, the individual I'm dealing with, understands why they need protection. It's not a case of selling anything. There's no purpose to doing that. If the client understands the need for the product, then they will take it out and keep it. And that means the protection is in place in the future. I know from a personal experience what happens when that doesn't take place. When cover's been cancelled, protection is not in place, and then someone dies. I've known a number of people where they've literally lost their homes.
Now, we're currently in Cumbria. Would you say there's a vast difference between Cumbria as a county and how it is applied to other counties, say, or even other divides of the country? Would you say that it's more being an uptake on protection products is far more in the south than it is in the north? Or
you'd expect so, because there are certain areas where you'd say Cumbria is more traditional, and it is, and better for it in some ways, but statistically we're just as a nation quite poor. And Cumbria doesn't stand out statistically as being worse than elsewhere, as far as I'm aware. I think the key thing is the element of doing something about it. That's perhaps where we're a little bit slower. And I think, our awareness of risk, we live in a fairly safe county. Lots of factors contribute to that feeling. The type of area we live in is quite pleasant. Crime rates are relatively low, and the crime that takes place not so severe. So we feel safe. We still leave doors unlocked in certain areas and so on. And that would never happen in an inner city area. So our perception of risk is a little bit different, but statistically on the products, I think where the real failure comes through is the advice process. We're not doing our jobs as advisors, educating the client to the point where they take the cover, and that's where it's got weak. And I probably suggest that's on the back of volume. Many advisors are focused on, for instance, arranging as many mortgages as they can in a week or a month, rather than the depth of advice and correct advice with each individual person. And because they're running so quickly, they don't deal with the protection area properly or fully.
I mean, I think...
Just ask about the permanent health insurance. Do you still do that?
It's still available, and again, it's an excellent product, and it should have a lot bigger take-up, but again, fairly rare.
Yeah.
There's no logic to that, because obviously the nature of the beast is that inability to keep your income going, and PHI allows for you to have 75% obviously as a maximum of your earned income, which will be significant support in the event of loss of earnings through illness and sickness. And yet the take-up rate, again, is sadly very, very low.
How does that compare cost-wise to critical illness for, say, a younger person?
Yeah, put it this way, critical illness for a younger person is incredibly cheap. If we did 100,000 a life cover with critical linked to a mortgage at the moment, even a joint policy, it costs in the region about £18 to £20. PHI is very much rated towards the job. Yeah. Less so critical illness. So the job would actually define more how much it might cost rather than just purely age. So lifestyle, smoking, non-smoking, the job, the risk of the job, those will have quite significant influence on PHI, less so on critical.
Right, so that's
it's
why
an individual thing. Yeah,
a lower take-up in this country, given the fact that there's less white-collar jobs up here.
Correct. Correct. And I think it's this element where the demographic we have is different to elsewhere. If you look at the earnings throughout the county, it's always been focused on agriculture and hospitality.
Yes.
Other counties, there's a far wider spread. We don't have significant large white-collar employers. There's the odd one or two of small to medium size, but not huge. Elsewhere, it's very different. So yeah, that will have an influence. An easy example is agriculture, where even as a youngster, the risks are high, therefore the premiums will be high. Right. Of injury or death caused by machinery. And again, it is something that sadly does happen quite regularly within the county. So yeah, that does have an effect, I would say, yeah.
Excellent. I know, obviously, the next biggest area that you work in is mortgage. Yeah. And financials generally. Now, obviously, it's been a rather turbulent couple of months, really, in regards to what's happening from the political side, as well as from the whole banking side, as well as the FTSE. Everything's kind of been up in the air in the last couple of months. How's it affected the general workings of mortgages and what's going on?
Right, I think context first. I mean, obviously it's a challenging time. There's been a loss of confidence in government. The whole juxtaposition about who is the Prime Minister or not Prime Minister will never help, but confidence is a major factor within any society, and at the moment it's lacking in our leadership. But context is important. Similar to the FTSE, if you look at the FTSE over the last 25 years as a graph, it goes up, it goes down, it goes up, it goes down, but there's a generic overall growth rate over the decades. Lending is not dissimilar. It's a confidence-driven industry because it involves people and homes. So at the moment, the level of activity in terms of confidence should be low. And yet the activity on the front line of lenders is high. They've got high volumes of cases. The counter to that is that a lot of those cases are pipeline that was submitted prior to the latest month and a half, 2 months. So they feel there may be a fall off in activity. But the real concern within the industry has been the lack of products available. The lenders themselves we often think as timeless beings. They've been around forever, 100 years plus each and so on. Some of the banks have been. However, the lenders are people as well. They're individuals, and many of those lenders are people that have only been in the industry for the last 10 years, even at management level. So all they've seen is a very consistent low interest rate environment, and this is new to them. So it has technically spooked them.
Yeah.
They are nervous, they are scared. However, having been around a little bit longer perhaps in the industry, it comes and goes. So I'm quite circumspect about it and think, well, okay, it's challenging, but we've gone through a number of other significant financial periods of distress, you know, name it, the credit crunch and so on. The COVID pandemic we all got through, and you know, everyone was still buying and selling houses as soon as we're allowed to. And the same will happen here. And like everything else, we'll look over our shoulder once we've gone through this dark period and think, well, it didn't last that long really, and it wasn't as serious as it could have been. And that seems to be the general trend in the modern era of lending and confidence, is where at the time it takes place, it feels quite serious and a major impact. But as soon as we pass by that phase, we look over and think, actually, it didn't hit as hard as it could have done.
Yeah.
Credit crunch is an example.
Yeah.
Again, the day before the official credit crunch day, I was at a seminar with the chief economist for the Australian government, based in the Lake District. It was a really good opportunity to meet one of these chaps, and he basically, unfortunately, at the end of the meeting, said to everyone in the room that I'm sorry to advise, but within 3 months we'll all be paying interest rates of 15 to 16%, to which everyone in the room naturally slumped in the chairs and thought the end is nigh. And the exact reverse happened. The interest rate nudged up slightly by about 0.75% to 1%, but then very quickly started to drop down in stages until it did then plummet to the levels where it did, and stayed there for nearly a decade. So even a chap as intelligent and capable as the economist for the Australian government got it completely wrong.
Yeah.
And there is this element now where we're going through a phase where the lenders are starting to just start looking out the room. What can we do? Is it safe to do it? And like any area of risk, they're hedging. And what I mean by that is they bring out a product at a given rate and they see how it goes. They then withdraw the product. Then they do the same again. So there's this sort of splattergun approach for the lenders of releasing and then withdrawing products. And they've done this before. And again, it'll just take a month or two for that to settle, in my view, and then away we go on a more stable base.
Yeah.
The price is falling now again.
Yes, just. Initially, what they actually do, no lender, I know you perhaps don't believe this, no lender likes to say no. It's bad press. But if they price themselves out of the market to the point where you don't even look at them,
you don't have to say no.
So it's that quite clever little gambit where, if something's too expensive to buy, you won't buy it. And that's what a lot of them did, where they escalated the prices to the point where no one was using them, and yet they didn't close the doors, or there wasn't a headline saying XYZ bank is no longer lending. And that did happen. 3 weeks ago, there were a number of articles saying that given lenders were no longer lending, and they weren't. They were simply withdrawing products and replacing them. But it's a really effective headline for the newspaper, but damaging for society.
It's also false.
Yeah, it's bad. It's bad press because it affects people's confidence, going back to confidence, and it gives people an incorrect impression of the real world. And it's wrong. It shouldn't happen, but unfortunately, that's the nature of our media and press.
Well, there's a doomsday narrative at the moment that, whether it be through COVID, whether it was through Brexit, or whether it's now with the financial crisis, there's always been a doomsday narrative. This is the worst case scenario, but it's never advertised as a worst case scenario. It's advertised as this is what's going to happen. We now see it with stuff like the shut off electricities and that's what's going to happen. And there's a massive amount of videos that's going out that's saying, oh well, you've got like stages of volume 1 and volume 15 of these different rules for shutting off electricity. But yet volume 1's worst case scenario that they're thinking, and yet they're advertising, putting out to the public volume 15, saying, oh, by the way, electricity will be off more times than it will be on.
And I guess that's because of journalism migrating from journalism to entertainment.
Yeah.
That's where it comes down to. It's something where, as human beings, oddly enough, we don't like a reassuring, nice, cozy story. We like a headline that's quite scary and grabs you, especially because over the last 20 years or so, become desensitized to adversity. So it has become more and more adverse to grab our attention. And I totally agree with this whole thing about the press position on it is, that the worst position is the one they say, okay, that's what will happen. Now, the one thing again, that dangerous word experience, I'm only going to ever use it once today, but that word experience, having dealt with things for a lot of years, is I have no idea what tomorrow may bring.
Yeah, I mean, my personal theory on it is the newspapers haven't found a realistic way of calculating how good their papers are now that majority of it is online.
Yeah.
And the clickbait and reading one article for a period of 15 seconds until you realise it's a load of crock.
Yeah.
Is what they're taking their statistics off now. They're saying, oh, well, we're really good because this article had this amount of clicks.
Yeah.
But when you've damaged your brand,
Yes.
where it used to be paper sales, you know, and they say, oh, well, now we're not selling any papers and we're going to go bust because we're not selling any papers.
There's a direct link, isn't there,
This,
between the two?
absolutely.
That's
So
missing.
I think the media's not modernised itself in regards to actually recording how valuable it is.
Well, it's actually changed. That's what's happened with the media.
Yeah,
It
absolutely.
is no longer a newspaper,
Yeah.
as you quite rightly say. There is still certain ones like the Financial Times and to a certain degree
Yeah.
the Telegraph
Yeah.
and Times
Yeah.
who do still try to tell the news,
Yes.
but the tabloids have now changed.
And like everything, it's the percentile-wise. If you look at the demographic of the country and the percentile of people that read or click on relevant pages, the majority don't read the financials, etc., which is a shame because they are most objective. So the media knows that they're targeting their product in the way that they want to the masses, and it's something where there's got to be a note of caution because if you go too far with that, you can influence outcome. The scaremongering and literally terrifying people who say, look, interest rates are going to go up so that the next time your existing mortgage deal comes to an end and you go to your lender and say, okay, can I have a new product? The rates will be so high that your mortgage payment is going to double. Okay. Now, that is terrifying to anybody because the majority of people have a mortgage where it's affordable, but a bit of a stretch, but it is affordable. And to double the largest commitment is extreme. The reality on the majority of the remortgage renewals I'm doing at the moment is the increase has not been the 500, 600, 800 in the press. It's been £60, £70. So it's within the range of most people's budget.
A lot of people don't realise that the vast majority of their monthly repayments is capital,
It is.
especially in the later stages,
Not interest. Yeah.
So the interest rates to actually put your mortgage up double,
That's right. Yeah.
interest rates wouldn't have to double, they would have to treble or
Correct.
possibly quadruple.
And that's again this misleading message, and it is unfortunate. But part of the job of advisors such as myself is to get the message out there to say, look, a little bit of calm, a bit of common sense and context, because at the end of the day, we can influence our future. You know, if we can be confident about the future, positive about the future, we can influence it ourselves as individuals. Again, we've partially got to the point where we think, okay, who's going to sort this for us? But the masses can sort it out. You know, we can ourselves change what goes on by, for instance, continuing to live normally.
I mean, the scary thing for me personally is what it will do to the younger generations.
Yes.
who are now looking to get onto the property market, who are getting onto the property ladder, who are more likely to read online clickbaity articles where this absolute rubbish is kind of, that's where it's all driven. And then they lose the confidence, so therefore they don't bother. The amount of people that would have actively been looking for a property during this time, and then this has all changed, and this is the worst case scenario, and gone, what's the point?
And the key thing is for people like me to get to those individuals, to be able to just talk to them.
Yeah.
You know, I don't want to use the word like educate, because in some ways that can feel a bit derogatory, but it is just to talk and explain what is actually going on behind the headlines.
You've got to educate, though.
You do.
Because the level of financial acumen taught in schools is non-existent.
It's, to be honest, that's true, because a bit of an eye-opener. My son's just literally started his career as a teacher 3 weeks ago, and it shocked him, let alone me. And my perception of what maybe I was wrong what I could do at age 7 or 8, but ultimately, what they're capable of doing at 7 or 8 and even later, it isn't what you expect. And perhaps that's reinforced because the regulator within financial services at the moment, one of their key projects is vulnerability. People obviously think of vulnerability as, is there something that could affect a client's ability to understand, to do, to whatever. And most of the time those assessments don't acknowledge the simple fact there's the person in front of you understand at all what you're talking about.
Yeah.
Can they even read? Have they got numeracy? And I've literally only last week run a risk analysis to develop that, so that in my own role, but also going to hopefully encourage some of my other advisors to look in that way, because often as a human being you'll present something and say, so is that okay, does that make sense? And naturally a human being would say yes. Moving on.
Nobody wants to admit that they don't understand
Correct.
something.
They have lived with whatever's been difficult for a lifetime and survived and coped and don't.
Or even more dangerous, especially in this county, a
Yeah.
lot of people have thrived
Yeah.
not being able to read and write,
Yeah.
have many assets, and then can be stripped of them very easily
Yeah.
out of things that we would say are basic.
Correct. It can be very simple for that to happen. And again, in financial services, we see it. It does actually happen quite a bit. And you presume that if someone has X amount of asset and accumulated, that they do have acumen, but it's not the case. And it's dangerous to presume.
Yeah.
And so part of the risk analysis we did was actually how to break down those natural human barriers. And most of the time, the way of breaking them down is building trust. It's communication skills, it's empathy skills. And not many advisors have spent time considering that. They've looked at conversion rates, going back to the volume, how many cases can they do a week, how many appointments have they got in a diary. But that's a critical part of our role now going forward. It is to look at vulnerability and people's numeracy and understanding, and developing our own skill sets as advisors to deal with that, and never presume. That's the key thing. But certainly in the current climate, I'd say the advice we give is critical, because it is the counterbalance to the media.
Yeah.
And the more we can meet people and talk to them, the better, by whichever means.
Yeah, brilliant. Well, I think that brings us to our kind of final topic, which is equity release. But I want to give it just a little bit of context.
Yep.
We've known each other for a good chunk of time now, I'd say a couple of months.
Yep.
Yeah, and we've been having a good chinwag. You've been fantastic in providing some information to us for our legal and financial services side of our site, 5 Minute Spare. Some great articles in regards to that, not only just about what equity release is, but the outside of the box thinking of equity release and what it can be used for. And I think that's exactly what you're saying in regards to your risk assessment. I think it comes so naturally to you as an individual, just because of who you are, and a conversationalist with client and all that kind of stuff. That the experience that you've got from just having conversations with your clients gives you the ability to have this out of the box thinking in regards to how these financial products can be used in not alternative way, just different ways to help them. And everything at the moment that's going on with the pensions, with everything that was said in the mini budget, and then the U-turn. I think it's a very, I'm not going to say volatile, because I don't think it is volatile, but it's definitely presented as volatile for people who are over the age of 55 or are approaching pension age or are in pension age.
I think you're right to say volatile, because
it is, isn't it? Really,
there has been some extremes of fluctuation, but it could be short-term volatility, and that's why we need to look through.
That's it,
the
isn't
noise.
it? Yeah, it's this element of a graph going, a bit like an ECG, but then looking at the context of the big picture again. But it is certainly something where ordinarily, if you were 30 or 40, you'd see an awful lot of a life journey ahead that puts in context. And you think, well, okay, we'll catch up later, we'll deal with it later. But you're right, if you're already at retirement or just about to retire, there's a timeline, a deadline psychologically, that if things are going the wrong way in terms of, say, pension fund performance and so on, naturally anyone would feel stressed about that. But again, it's to simply get to that point of being able to advise people, like any other form of investment, that unless you're in cash at the wrong time, a loss isn't incurred. It's a figure on a computer screen, on a statement on a piece of paper. It's that point where you liquidate the fund. That's the point at which it takes. So part of strategy and planning could be to what I would call defer. So that's where equity release can come in, because if at the moment it's simply the wrong time to draw down your investments, to draw on your pension and so on, it's the wrong time. So is there an alternative? And unfortunately, equity release in the past has always been sold as a product, as being a large lump sum product to blow money on anything. And that's the truth. Whereas now, from an advice perspective, it's a lot more evolved. It's a lot more developed as a product, whereby we could provide an initial lump sum, for instance, for home improvements that you intend to do, but also then allow for a drawdown, a reserve in the background that someone could draw from a wee bit at a time on request, without need to reapply, without the need for further fees to be paid, to simply top up income until such time as perhaps that pension could come through. And a lot of the products as well now have what they call fixed early repayment charges, and that simply means a fixed penalty period with defined terms that again you can use to plan around, such that if you don't have the money now but you know you'll have the money in 8 years' time, we could physically plan around that so that the funds, when they do become available, could then repay the equity release without penalty. So it's something where certainly we see equity release differently in the way it used to be used, the way it's used now, but it is simply one more tool in the box. I always see lending as tools in a box, but what comes first is my client and their actual needs. And that can be different to what they think they are.
Yeah, I think from everything that I've looked at in equity release, and also all the different conversations that I've had, I know, Craig, we've had quite a number of conversations about equity release. It seems to be, for me, the way that I've looked at it is the only limitation on equity release is if you haven't got a property, which just means you can't have it.
That's the key. And it's something where the best way to sort of describe equity release is it's still a form of mortgage without a payment, fair enough. You can make payments if you wish to. But because it's a mortgage, it needs a house, a security. Now, by the nature of equity release, whilst we've mentioned there about paying it off early and so on, the majority aren't. They tend to run for the life of the client. So after they pass away, the lender gives the family a year to decide whether to sell the house and pay the loan off, or to raise funds to pay that mortgage off and keep it as a family home. So the majority do run to maturity. So ultimately, within the context of that, what we've got to do is say, okay, equity release, what is it? What does it represent? And for me, most of the lenders say it has to be low risk. And part of the risk for them is the property. Can they sell it easily?
Okay.
So by definition, your home needs to be your home.
Yep.
It needs to be readily resaleable. So factors that could prevent that could be...
Close to a pub.
Got it. Or you are half petrol station, half home. Or your property, literally on the back of it, is a nuclear power plant, etc. So things that could influence resale can affect your ability to get an equity release.
Does the holding structure also affect this, like potentially younger people living in the house at the time?
It does.
Maybe.
And again, lenders,
people.
Lenders are often perceived as a sort of Dickensian sort of grim reapers, and they don't care. It's not so. They're very careful to make sure that anyone involved in the process, which includes dependents or family that's still living in the home, that they know what's going on. I always meet with the families as part of the process for that very reason. And the lender doesn't want to be in a position of, technically speaking, turfing somebody out. They don't. They don't want that position, because everyone loses.
Well, they also don't want to be in a position of, say, contested probate.
Awful. Yeah.
And it's, like you said, it's the underwriter's job generally to have a look at it and go, right, how easy is this going to be to turn over as a product?
Correct.
Whatever it may be.
And in our area, for instance, it's the importance of independence, which is what I'm an independent advisor, is there are some lenders that will not lend if behind you there is a field that is either ploughed or occasionally has a cow in it. Now, given the propensity of agriculture within our county, that is vital.
Yeah.
Some lenders do not mind at all, some will not lend, and that's why the independent side is important, to have that knowledge of knowing which lenders can or can't support that particular property. And a further example is that a more recent evolution is again within our area. We do have a lot of people that have buy-to-let properties.
Yeah.
Because their view is that they didn't trust in pensions and have instead got one or two buy-to-let properties to provide that income in retirement. But they can again be relatively asset rich, but the rental yield's not too large, so they can be cash poor. And there is one particular lender now that will look at doing an equity lease on a buy-to-let property.
That's interesting.
So it's an evolved product using, to some extent, common sense, because what they're saying is actually a buy-to-let property is still just a house, a home that could readily resell. So I think that lender's been quite clever and sensible.
I think it's good for the geography where we are.
Yeah.
I mean, especially when the actual rent yield is probably so low compared
Incredibly
to
so, yeah.
a lot of the country.
Yeah.
I think it's nice to see flexibility in that market.
There is, and it's good for our county because it's brilliant for us. That's the thing. It's something to be really,
does
really
this
helpful.
extend to like holiday lets?
Yeah, it's basically this whole element of, is it a house?
Right.
Is it a standard, normal home that could be sold in the event of the client's demise?
Just one little thing which I think a lot of our listeners might be interested in knowing is, how does this interact with long-term care?
Well, that's the other aspect that's interest to me, and what I find intriguing and frustrating at the same time is that as an advisor, I can see the direct benefit and link between equity release and provision for long-term care. We all know that if we do nothing and we own our own home and you go into long-term care, the state has the powers to asset strip in effect that property down to zero to pay for long-term care. But you don't then control the long-term care you receive.
Yep.
You could go into a state home and the standard that might be good, might not be, but you have zero control. And I know as an individual, I'd prefer to have more control on what I do or don't do in later life. And there are products out there that can provide the money to ensure you make those choices yourself, that you can go to a given standard of care home with a given standard of care basically at the end of your days. But it costs money to purchase that product. Right. And again, going back to where we began about our country and our failure to buy into protection and other financial service products, this is another great example. We all know we could and should do it. We all know we can do it, but we don't. And I'm currently working with 4 independent financial advisors that specialise in investment, pension and protection with a view to promoting long-term care provision. As an example, it could be either if the provider requires a lump sum payment towards the plan, if you went to an individual and said, okay, in case you go into long-term care, would you give me £30,000 today? As human beings, everyone goes no. Whereas if we use equity release and release the funds to pay for that, it makes it less painful as a process. Or equally, if the provider wants an annual or monthly premium to provide that cover, rather than a client paying £300, £400, £500 a month towards it now, when they have very little income, we can use the equity release to fund it. The take-up rate has been abysmal. So it's important that we keep ploughing out there the message that it's something that we all must look at and deal with. It will not go away. The system nationally is struggling, both north and south of the border. North of the border, Scotland, there is a complete disinformation on this area. The system is bankrupt. There's this whole thing about free long-term care within Scotland. The system is financially bankrupt and it won't carry on. So ultimately, no one can hide. You can't simply slip over the border to Scotland and get free long-term care, which is what some people presume they've done. So yeah, it's up to us as individuals to pay for it. And one of the benefits of being a homeowner and having worked all your life to get to the point you have a mortgage-free property is that you could, fund a more comfortable long-term care plan.
Of course, that does fit in nicely with IHT planning for those who fall into that barrier.
Exactly. It's something, it forms holistic advice.
Yes.
So we've got the situation of what does someone need, and that can be short-term, medium and long-term. Yeah. And very rarely, you'll appreciate yourself as a former advisor, very rarely can you do it with one product. No. And very rarely can you do it in one go. It tends to be something where it evolves so that you give advice perhaps blending one or two products at the moment, and then as you do your annual reviews and your regular contact with the client, we evolve and develop that to then move into the second, if not third and fourth phases through that ongoing relationship with the client. And that again means you need to make that commitment of time to make sure you do regularly meet with your client and you're available. Again, going back to a mention about being available. So it's something that for good financial advice, it's a great area and it's a necessary area. But again, you could say it's up to the government to do something about it, but really as advisors we need to do something about it ourselves.
Yeah, I think for me, these sort of professional services, whether it be solicitors or financial advisors, any sort of advisors, to be honest, there is a clear danger with volume-led work that's going on at the moment in regards to having hundreds and hundreds and hundreds of clients a month. Fee earners, financial advisors having to plough through and just go and do as many clients as you can, rather than actually doing as many good jobs as possible. And just dividing your month up, say, right, well 60 is my optimum, say, and I'll always have a book of 60 because this is what I do.
Correct.
And I think that's been lost, but you can see that in the way that these products are marketed to the general audience.
Culture.
I mean, Christ, when I turned 30, which wasn't long ago, luckily, as soon as I turned 30, I straight away started getting advertised in regards to health insurance, life insurance, sorry. But that was it. So I was never informed about critical illness cover. And currently, as I sit today, I have not got any critical illness cover.
We need to sort that out.
Absolutely. So, but also, like, if I'd have come to a financial advisor like yourself and gone, right, well, let's have a look at what you are now. How prepared are you for retirement, and why aren't we looking at that now? When you start your work and you've got income coming in, why isn't that a time to actually start planning for retirement at that point, rather than just relying on state pension or relying on pension schemes that are generally built for those who are well above working class, well above middle class, and they will do them well. They don't do Mr. Average Joe Bloggs very well,
person, isn't it? It's again, you sort of to figure out why is that culture exists in the UK. If you look at the people in the industry, there are a large proportion that have come through from the banks, where their job every day was to have 6 appointments in the diary to sell X number of products. Otherwise, they were hammered by their employer, let alone didn't get a bonus. It's a very aggressive culture. So naturally, they are pre-programmed and predisposed to operate that way and carry that mantle with them through into their other careers, their other work. And there's a lot of people I meet that's probably why they do what they do. They look at the volume, but they also look for what deemed to be the easy hits. If someone comes along and says, I have 50,000 to invest, they've got an open door and they'll deal with it. Someone comes in and said, right, I want holistic advice that involves cash flow forecasting, protection, pension, perhaps a bit of lending, etc. It's quite complex, and they're less keen to deal with it because you need to invest time initially to get to know the client properly. You need to invest time to understand their financials, and you need to invest time then to actually look forward towards planning. And all of that initially without remuneration. Whereas if someone, as I say, comes up and says there's 50,000 to invest, they can do it and get income. But what I would say is, whilst that sounds a bit down, it's not, because I think for financial advisors to survive and do well going forward, they have to be different to anything that could be provided online by a machine. Online by a machine is very efficient and could be suitable for some people, but it's what I would call transactional. I want, I buy. An advisor needs to be able to show why they add value to the client. Why should they be paid commission to arrange something? And that's where an advisor needs to evolve in the way they do. And I'm quite positive that the next generations of advisor will be even better than the ones that exist now, because they understand that. They can see they've got to add value to the whole relationship way beyond something online. Otherwise, they simply will not get business. And I also think that individuals, people, the consumer, are more discerning. They want something. They know the difference between good and bad service. Whereas perhaps when I was younger, I didn't even understand the word service. You just got given something and that was the end of it.
So you've got to provide value for money now.
You've got to.
Yeah.
And I often speak to my clients in those terms. First meetings with them, I say, look, I want to deliver value for money, and unless my fees that I charge and the time I ask them to spend, I can't genuinely see I am going to add value for money. I will flag that and tell them that.
Yeah.
And equally signpost them to perhaps who is or what is the most appropriate avenue for them. Because I cannot be horses for all courses. But what I can do at least is use the knowledge I do have to make sure that the client gets to where they should be, if it isn't me, safely. Violence in the workplace.
Use somebody with Dr. Microphone.
Well, I think this is one of the things that kind of I've personally identified as my biggest worry about equity release, is that it's currently, even though it's not highly driven at the moment, but what is driving it is the big players, and it's these big brokers where we've seen with conversations with people is it's already got that factory feel where nothing else is really discussed apart from I want money out of my property and this is how much I want, no problem, this is how much it costs you. Nothing about this is what, let's analyse exactly what position you're in. Is it good for you? Is it not good for you? Have you got other options?
Correct.
All this kind of stuff. There is, like you said before, there is an education side of it missing, which is why we wanted to bring this together. Was so we could have a discussion about this, that and the other, because the benefits for me for equity release is it can service the wealthy very positive in regards to IHT and inheritance planning.
Me and Luce are both from a legal background, so we've done a lot of trust work. And IHT can be used very successfully in those areas. But it's for the people who are not in that bracket that we needed just to have this conversation just to clear up what it's good for.
And the truth of the matter is, I mean, again, this is from clients telling me this. They have contacted some of those call centres, and because they want a modest amount, they're not interested. They deliberately don't return calls, and they're unavailable because they only want the big hitters for commission, and that's wrong. It's simply wrong. So again, I don't have a minimum. I talk to people as they are, and it's something where somebody that is on modest income with not a large house and so on, they have needs, they have stresses and worries in the same way as other people, and it's certainly something where that's where our industry is failing. You're right, it's gone transactional with big industrial sized businesses, very efficient monsters, but they're not offering independent advice because they are tied to a given lender. You know, they literally arrange their own products, full stop, the majority of them, and they certainly don't give the client time, and that's where again though there is opportunity.
I mean we've discussed it quite a few times, especially in regards to the middle classes and the working classes, and how equity release can apply to them, whether it be to fix a cash flow issue or whether it be to assist a family member. So say if an individual's a child is going through a divorce and they're going through an extremely difficult time, and the only fix for them is an injection of cash that might be temporary, but you've got a working class family, so that the parents of that individual haven't got the cash, just haven't got that cash, but they know that's the answer. They can use equity release, but if you were to go to a big player, then that is where that service would stop.
Correct.
But if you went to an individual and said, an IFA like yourself, then you could go straight off the bat and say, right, well, this is what you're using it for, no problem. Let's secure what you're using it for. Let's speak to a solicitor.
Correct.
Let's do this.
That's critical.
It's
part of that advice
huge
process, because as soon as you look at a parent, they always want to help. It's the most human of instincts, and it's sort of the right and good thing to do, but equally it's doing it safely and securely, both for yourself, for your child and so on. And unfortunately relationship breakdowns happen. Sometimes spouses aren't quite as nice as they hopefully would be, and that's where the advice structure and contract work is important, because it's a case of helping, but helping safely.
Yeah.
Because again, you mentioned there about the fact it could be temporary, where you agree with your child that, okay, you'll help now, but as and when they can afford to repay it, they repay it. Putting that into writing, let's call it, is critical for everybody.
Or in trust.
Yeah.
Yeah, and putting something in trust.
Because put it this way, you've got this element where I think everyone feels better for it.
Yeah.
It's this reassurance of knowing everything's been done properly, correctly, documented, so that if anything goes wrong, everybody's still okay. And that's vital. I mean, I often speak to equity release clients all the way through the journey. I was speaking to one this morning and said, look, the one thing you never want to ever do is wake up one morning, look over your shoulder and regret having done it, or worry about having done it. You know, if you're going to do it in a way you know you feel safe, you know it's right. And the best way you can do that, again, is advice from the relevant professionals. And that's why we're working together on this, but with myself, because there are so many areas where we join naturally. It's the right thing to do.
Yeah.
And it's seamless. And that again is important for the client, because then we can actually talk to the client as a team. There isn't a gap. And I mentioned this to a client last week, actually. They have another solicitor, and they can do certain aspects of the work they need. And I've actually said to them, look, I wouldn't knock that solicitor. I think they're an excellent solicitor, but they can't deal with the whole picture. And if they can't deal with the whole picture, there could be a gap.
Yeah.
Inadvertently, or for whatever reason, a technical reason, don't know, but fundamentally deal with something holistically. And that client is not going to deal with that work through me and with Butterworth because of that element of dealing with it holistically. It's really important. Plus, they know then that both their solicitor and their advisor are working together for them.
Yeah,
as a team.
It's very beneficial for a multitude of things. Number one, just for the client confidence level, because without having that client confidence, you don't get the information from them that's required to actually make the right decision from them anyway. Correct. And knowing that you're going to get that holistic service, like I said, that eclectic service right through to say, I've spoken to Butterworth solicitors, so I'm going to pass this information through, and they know exactly what they're doing because not only, they also spoke to you right from the start as well. Is a massive, different experience than what you would get with anywhere else.
And I have dealt with situations where there was one where there were literally 3 solicitors involved on one case, and to say the ball was dropped in between each day was an understatement. And it wasn't because somebody was incompetent or anything. It was just simply by having too many hands in the pot. It was going to happen. It was going to happen.
The process doesn't work like that, does it?
No.
You can't do a multi-level of conveyancing, which is essentially what it is. It's just multi-tiered conveyancing. But none of them documents get updated and then passed back, and then you see what's changed, and then you do your work, and then you pass it back again, and then that gets changed. You've basically got 3 different areas of work going on simultaneously that then go back to the land registry, and land registry go, well, this isn't right.
Correct. And time is vital with equity release. With a normal mortgage offer, it tends to have what I call a shelf life, an expiry date of perhaps say 3 months, some 6. But the lenders quite flexible that they would extend the offer date and the interest rate, most importantly, if there is a delay. And as long as they know it's a genuine delay, and they'll support that, which is very good. Now, equity release lenders, again, many will extend the offer, but in the brackets following that is they will then renew at the then prevailing interest rate.
Okay.
Now, bear in mind, we've been in a very static, low-level interest rate environment. That bracket statement hasn't really meant an awful lot, because even if there was a change in interest rate on the offer, it might be 0.5, well, not even 0.5 actually, 0.1% or even lower. We're now looking at migration of rates of nearly 1.5, 1 3/4, nearly 2% on some offers. So if things aren't dealt with promptly and efficiently,
it makes a difference.
Bang, huge difference. And we're talking now of a rise of what could be nearly about a third of the overall interest rate, and that is significant. And the situations where I've seen it actually happen, and others that have come closer, where there've been what I would call legal ping pong between too many people. That's what's caused the delay. That's led to that risk. So again, it's an area where by having a very close, efficient team, that mitigates risk of rate increase on offer.
So in regards to Cumbria especially, I know last week we as 5 Minutes Spare, we did some work with both yourself and Butterworth solicitors for a free advice surgery in Harrowby. So that went I'd say very successfully. Was a very good for customers, for clients, for everything in between. So we're wanting to bring a few more them to Carlisle especially to start off with, and then we're wanting to drive that across the Cumbria area. We're going to drive it down Cumbria, I think, is the way that we're going to do it, just so we can schedule it nice and simply.
Not much north of here anyway.
Exactly.
And so for everyone who's watching and everything like that, we'll keep an eye out for that, because Ian has already said that you're going to make yourself available. So we're going to be hitting quite a few areas, so you can physically see Ian in a more accessible place if you can't get in to see him. But I know, Ian, you also do home visits.
I do. It's that element of what fits for different people, and in the area we live in, some people feel a bit nervous about speaking to someone in front of a neighbour or a nearby area, and sometimes privacy is important. So we just fit around what's best for them, but it's the best way is just to meet and chat. And whether it's through the sort of the meetings that we're holding, and it went really, really well. I enjoyed it, and it was a horrible wet day, but it didn't put anybody off, and that's a good litmus test. So people came through the rain despite the rain, and I know everyone enjoyed it, including the clients, because most of them sat there for quite a long time. Chatting.
Just one little quick thing, just because you're based in Carlisle, do you cover other areas just in case somebody sees this, maybe living in Lancashire or something?
No, so the entire country actually. I have clients from the very northern edges of Scotland all the way down Cornwall and overseas actually, but yes, there's no geographical limit, and the will be what it is. It doesn't take an awful long time to get from A to B.
No.
So it's something where
but you can do them over like Zoom or Skype.
Or something. And that's one of the benefits of COVID, because until COVID, not many meetings were held in that way, but now it's common. And perhaps what's also important is become more normal, more relaxed. So instead of being a strange thing to
more
do,
along the lines of like secondary questions, you may have had your first meeting with a client,
that's right.
But then you might want to have a follow-up with them just to answer a question. They might have a query. You might want to just double check something with them.
I would say
you can utilise technology for that now.
I mean, God love the clients. I would say on average about 8 to 10 meetings stroke discussions on equity release. Some smaller, but it's vital. You're right. In terms of technology, it makes that happen, because, again, looking at Cumbria, we are in a remote county. So even if it's further afield geographically, the client,
the third largest county.
It's huge, and
the 47th most populous.
And as with anything else in life, even though someone might be over 55, they can still be very, very, very busy. So fitting a life in around that.
I'm over 55. I'm very busy.
I'm the same. I'd get different mail to you. They no longer send me life cover, they send me death policies. So now I'm over 55. It's a hint. But ultimately, it's this thing where people have busy lives. So be able to have a meeting on, say, Zoom or Meet or wherever, you can do that and then carry on with life. It's absolutely brilliant. And what I found encouraging, though, is the demographic, because so many people use that now. It's not an age-related thing.
No, I think that's the one thing that we could possibly thank COVID for is training older generations in technology, because it was the only thing that they could use. I mean, it got to a point where if you didn't do your shopping online, you couldn't do your shopping.
Correct. And that broke a lot of barriers that probably are still in place now, obviously. And it helped, weirdly, break through those barriers. But also, it was often the thing that made people feel less isolated. They could have contact with a family member or somebody else, even though we weren't allowed to leave the house. And they saw the benefit there. It's all carried on, and certainly now far more commonplace. And again, it's a sort of thing where it can be a problem solver. I mean, part of our role, we collect ID, identification of people, and you can actually use your identification documents to the Zoom to link them together, so that that passport does relate to. So it's a good tool, a good problem solver, and it's becoming more and more prevalent. And certainly advisors are using it a lot more, because again, you don't need to get in the car and travel 2.5 hours there, back.
Especially now the cost of petrol.
Well, the week before last, I went to see a client who was 2 numbers away in terms of postcode area. And so it's like, CA2, for instance, versus CA4. Those weren't the actual things I'd for privacy, but CA2 to CA4. However, in the real world, it was a 2.5-hour journey each way.
Yeah. It's staggering.
Plus the meeting. So it was an entire working day to go and see somebody that was literally 2 numbers away on a postcode area. And again, it's something that perhaps if you're in the middle of an urban environment, you wouldn't recognise that, you wouldn't even understand that. But it's something that we're very mindful of as advisors, because again, we need to make sure we're efficient with our time.
Oh, I mean, Cumbria is a very difficult area to serve if you don't understand the context of Cumbria.
Yeah.
You have to be very forward planning. You have to be prepared to do more than what you might have to in other areas. But it's a lovely place to live.
And the great thing about it is that because of that remoteness in some areas, each area has grown up with its own culture, its own character, which is brilliant. There are areas within the county that are so different to each other, and that is brilliant for me. I like that. Because again, you don't necessarily see that everywhere else. So it's got a lot of diversity, a lot of fun factor to it, and that's really I've stayed in the area advising. It'd be very easy to move elsewhere.
You sound like a tourist advisor now.
Yeah, bargains.
Straight into
another
area.
Like holiday lets.
That will be the subject of a new podcast.
20% discount online for holiday lets. Yeah, but no, it's a good county that. Got interested in it. It's something that's in the bones, it's part of where you are. So I think it's something that you feel a bit passionate about. But I think ultimately we sometimes put ourselves down unnecessarily. It's a good county, so I think it's something. Let's look after ourselves. And again, great believer in local business.
Yes,
keep it local. Feedback into our local business. Use each other. Use local advisors. Use local solicitors, local accountants, local business people, because it's really important going forward that we do that. It really is.
Yeah, I mean, it's our big ethos. 5 Minute Spare is to support SMEs as well as other things that would fall into that SME without being a business. Stuff like local groups and charities and all that kind of stuff. And I think we chose Cumbria as our starting off point because probably it would be the most difficult place to achieve it.
Yeah.
And we've got a lot of exciting things coming up in regards to that. And we'll, whether it be our town guides, our groups, our selling functions like our multi-vendor store and all that kind of stuff. So that led me quite nicely into that. Thank you very much. And so supporting like we support you and pushing like that, so that our services are available to anyone who falls into that category. So I wanted to say thank you very much for coming to see us and having a good chit chat. Thank you, Craig.
Thank you.
And what I'll do is, for anyone who's watching at the end of the video, I will place a link of where to find Ian Waters if you want to contact him in regards to any sort of questions. I know how open he is in regards to nothing's a silly question. Give him a contact, push it through.
Some things are silly questions.
Some things are silly questions,
I normally come up with those, so it's me.
And I'll also put links into all the information articles that you've done for us. I'll get all them into the end of the video.
Very good.
And thank you very much.
Thank you, guys.
Excellent.
Enjoy the rest of your day.
We'll see you next time. Thank you.
Bye now. Bye.